Hi, everyone. My name is Lyndon Smith, and welcome to the Business Growth Factor. Today, we're going to be discussing a cash flow firewall. The Business Growth Factor, here we have conversations about building better businesses, and I'm joined on the call here together with Josh Leyenhorst, and we're going to really dig into the logic around creating a cash flow firewall. A little bit of a quick introduction to myself and our business. I got a company called Expansive Edge. We work with small to medium-sized businesses that serve the trades or construction industries, and we help them extract and document their processes so that they can organize and scale their companies without all the chaos. Josh, I'm going to hand over to you for a quick intro, and then we can dive straight into the call or the conversation for today.
Yeah, thanks, Lyndon. I'm Josh Lyyenhorst. I'm a principal at BasePoint CPA, BasePoint Accounting and Finance. We're a CPA firm in Canada here. Also, primarily working with the construction and trades side of things, and we focus on maximizing profitability, optimizing cash flow, along with all the other fun accounting type stuff. So yeah, you said the word cash flow in your intro there. That sounds pretty interesting to me, and is seems to be like one of those like pain points with most business owners at some point, right? Is the cash flow side of things.
More than at some point, I would say. We're always looking at cash flow, right?
Yeah, 100%. So you use the word firewall there, Lyndon. What are you kind of thinking there with that term?
Yeah, so cash flow firewall, I think a lot of the times companies, they have challenges with cash flow, and the conversation we're going to have today is how can we create a firewall to protect that cash flow from, like being eroded? Because like you said earlier, a lot of companies bump up into cash flow issues. So how do we, what mechanisms can we put in place to protect that, or just to create a bit of a structure where it works, where we can
Like,
monitor that cash flow more effectively. So one, I mean, we can dig into this a little bit more in the conversation, but one of the points are, is to separate your operations account into like different types of accounts. So if we had to lean into the profit first approach by Mike McAllowitz?
Mike McAllowitz, yeah.
Yeah, he's got some methodologies around this, but effectively the way I see it, and I think you can speak to it, is you want to have your check account, your operations account. That's the typical account that every business would have. That's where revenue flows into. And then you would have a tax account, and a lot of companies don't set this up. This could simply just be a savings account where you're portioning some of your tax funds, your tax liabilities into, so that when your taxes are due, you're not looking at your operations account and being like, oh, I gotta fork out 20, 30, 50, $100,000 to pay to the tax authorities. In our case, it would be the CRA. And what impact does that have on your operations and
Right.
cash flow in that respect? And then on the other side of it is the profit account. So once you've got that revenue coming in, how much of that money is actually allocated as profit for your business after you've covered all your expenses, paid your team, materials, all that, typical cost of goods sold, everything that you'll have on that, profit and loss statement. Portion those funds into a profit account so that you can divvy out or draw from at the end of the year, essentially.
Mm-hmm.
So, yeah, what are your thoughts? Just going into this conversation.
Yeah, for sure. It's yeah. So the book Profit First, a really good book by Mike McAllowitz, as you say. What that book does is it recognizes the reality of just the fact that people make a lot of business decisions like in their business based on the bank balance, right? And it's normal. I mean, as a business owner, you need to hop into your bank and make sure you have sufficient funds to pay your liabilities, pay your vendors, right, pay your trades. Um, on time, right? Just want to throw that in there just because, especially in the construction industry, it could be a bit of a friction point often in terms of payment timing. But that all flows into cash flow, right? And so business owners, understandably, and from a responsibility level, absolutely are always in their bank accounts looking at what the balance is. What ends up happening is when you just have one account, and this is very normal for lots of people. So if for anyone listening, if you only have one operating account, like you're not unique in that. Most business owners just kind of have one or two accounts set up don't have a strategy around this. So what the book Profit First kind of does is it looks at that reality of like, okay, so business owners looking in their bank, maybe there's like $250,000 sitting in there. You've got like a, smallish business there, small, medium sized business, you got like say 250K sitting in there as a cash base. And you're like, okay, we're doing pretty good, right? Maybe we can buy this piece of equipment that we were thinking about buying. But without realizing, okay, within that 250K, we've got a certain percentage that's, related to growing tax liabilities, whether that's like sales tax or income tax. There's also a portion of that that's going to be like payroll within the next 2 weeks, right? Portion of that you probably as an owner should take as profit. And so the reality is, and this is super common for a lot of business owners, myself included, I've done this. You take your profit last, right? It's just normal. You're like, okay, so I got to pay my team. I have to pay for the equipment. We got to pay our vendors. I guess I won't, I'll pay myself my salary, but as far as like any additional profits, I'll forego that because I want to get this equipment or whatever it might be. And so what the Profit First methodology does is it takes a percentage of what's coming in from your revenue and it kind of siphons it off. It's sort of like the old school envelope budgeting method. If ever you've done that, right? You've got the food, envelope and the rent envelope and the vehicle envelope, and you put cash in each of them, and that's what it is, right? And so then okay, I have enough to cover my budget for each of these items. What this method does is it kind of, instead of using envelopes, you're using bank accounts. And so as money comes in, you siphon it off using target allocation percentages, they call them, or TAPs. So a specified percentage. So you're like, okay, if I have $100,000 coming in, say for this invoice, I'm going to take 15% for possible taxes, maybe 5% for profit. You move them into these specific accounts, and then that way you have the cash there for when the time comes to pay those things out. That's sort of the idea behind it. Again, trying to address the reality of the fact that people make decisions from their bank balances instead of their financials.
Yeah. I absolutely love the analogy of your envelopes. It takes me back to when
we're that old, Lyndon. We are that old.
Giving away my age here. Gosh. Well, I never did it. I just watched my parents do it.
Right. No, I heard that was a thing. That's what it was.
My grandparents, right?
That's right. Yeah.
Yeah. So maybe before we dive deeper into this conversation, maybe just an understanding or just more of a conversation around why cash flow is like the lifeblood of a business. There's that great old saying, revenue is vanity, profit is sanity, and cash flow is king. Why is cash flow the lifeblood of a business?
Yeah, I mean that's a good question for sure. Like, and this we use that saying all the time. Like, we actually use it, probably overuse it here at Base Point, but because it's so critical. Because I could fairly easily probably start a company that would be doing about $10 million of revenue by the end of the year simply by selling stuff at a loss, right? It'd be such a good deal that I would have sales coming in the door like crazy because it's such a good deal. I'm operating at a loss. I'll go under because I'm not profitable. However, maybe I'm having great profits. That's great. But if I'm not collecting the cash or the cash flow is bad, even if you're a very profitable company, you'll struggle. And we, in the construction industry in particular, you see this, for especially say like commercial construction, you have retainage or like lien holdbacks that's held off of cash that's coming in, right? Sometimes you have the classic like deficiency holdbacks that are also held off of payments. Then there's the payment timing issue, right? Quite often, moving, like for any contractors that move, say from like residential into commercial, they go from like almost paid immediately or within like 14 to 20 days. All of a sudden they're getting paid like 30 to 45, sometimes 60 plus days. That all impacts cash. So maybe the numbers look good on paper. It's like, hey, we're quite profitable in this job. But if the cash isn't coming in for 60 days, but in the intervening time, you have to pay your team, right? You have to pay your trades, like any trades that you have. Temp labor is pretty common on construction sites. Those usually you have to have that paid within 30 days. If you're an electrical or mechanical contractor, quite often, even millwork, for example, you have a lot of material costs. And so that has to often be paid, within 30, 45 days. So you're not getting paid for 60. Now you start to realize, whoa, we might have cash constraints here because we have these pretty significant obligations of cash outflow. But if the cash inflow is not matching that or preceding that, then you're in a cash crunch. So that's sort of the idea behind, I suppose, that whole cash is king idea.
Yeah, 100%. So with that in mind, like just I mean, what happens to a business when they have a cash flow crunch? I mean, your focus now starts shifting from doing excellent work, working with your, like, leading your team, to now you're firefighting because you haven't
Totally.
predicted, right? You haven't forecasted this, you haven't planned for this. Now you've got a cash flow issue that you need to deal with. So you've got to go take. I mean, how do you typically deal with this? You got to go get loans, or you got to get funding to kind of bridge that gap, which
Mm-hmm.
typically ends up costing your business money. So that starts eroding your profits, and it really puts you into a bit
Tight
of a
spot.
predicament. Yeah,
Yeah.
with your sub trades, with your suppliers, with anybody that you're working with, anybody that you might owe money to, and your employees. I mean, if you can't make payroll at the end of the month, or biweekly, however that looks for your company, it puts a lot of pressure on the owners and the leadership of the business as well. And it really shifts the focus from being proactive and leading your jobs and your projects to, hey, we've got a problem here. We're in deep trouble.
Yeah, for sure. And for anyone who's been in the business for a good length of time, you've probably experienced it in one way or another, where maybe you've worked for a company or owned a company that's either made those phone calls, right? Calling trades, being like, hey, do you mind if we hold off on payment for a week? We're just like in a bit of a tight spot, cash spot. We're just waiting for payment on whatever this is, right?
Yeah.
It does happen. I've seen it. It's not it's not that it doesn't happen. So again, anyone listening, if you've had to do that, you're not alone in that. Um, but yeah, quite often, proactive cash planning is kind of key on that, right? And so if you can, I mean, this is diverging a little bit into like cash flow forecasting, but if you can anticipate what your cash flow is going to be looking like in the next 3 months, you'll at least know, okay, we're actually hitting a bit of a cliff, at this point. So you can proactively go deal with that. Because, from a negotiation perspective with lenders, you always have the strongest leg to stand on when you don't need it, right? If all of a sudden you need it, they're going to ask for your firstborn as collateral. It's like, they have all the leverage at that point.
And the
That's
cost
getting into
of
planning,
debt
but
is expensive, right?
yeah. Yeah. All of a sudden rates are a lot, you won't have much negotiating room on the interest rate, right? So
Because you're good.
yeah, yeah.
Yeah,
So then getting back to what you're saying then, Lyndon, like these tax accounts, or not tax accounts, but like these specific accounts in the bank, it's a good way to proactively then move cash around. We were talking about this a little bit before we hopped on here. If you look at your bank balance, you're like, oh, okay, we've got say 250K in there, we're doing pretty good. But if you actually siphon off the cash into their respective accounts, right, to make sure you can pay your payroll. So you have like an operating account for like your payroll, your trades and stuff, but then move some cash in for taxes, because especially with growing companies, you're going to have an increasing tax liability over time, right? I mean,
yeah.
companies have to pay their installments over the course of the year, and based on their tax from the prior year. But if you're growing, then you're going to have a difference between that. So you're going to have a growing tax liability, as well as, say like your value add taxes, like HST, GST. Um, so if you siphon those off and then also move some into profit, then you're left with a smaller amount, right? And then you have a bit more of a reality check. You're like, okay, this is actually how much cash is sitting in here for operations. Do we actually have enough to buy, let's say, like this equipment that we wanted to buy?
Yeah.
Sorry, it looks like you want to say something, Lennon. Go
Well,
ahead.
there's also like a mindset shift around it, right? So like your mindset around, like, oh, we've got all this money versus, like, this is the reality, like you're saying, and this is what we're really dealing with. So you can see then, oh, we're actually not as in great shape as what we thought we were. we need to start filling that pipeline. We need to start, increasing our margins on projects, or just being a little bit more intentional about how we're doing things so that we can create better efficiencies throughout our operations.
Yeah, for sure. Yeah, because if you're looking at it and it's like now trimmed down quite a bit because you've moved out your profit, you moved out the tax liabilities, you've accounted for the fact that you've got payroll coming up in the next week or two. And you're like, okay, so we can't now buy these things maybe that we were thinking about buying. Quite often what happens with the owner, it's like, oh, okay, well, maybe I'll just not take a profit this month, right? Still pay my salary, not take profit. But really, as a business, you're like, okay, well, theoretically, if you want to be able to get these things, you should be profitable enough to do it. So then, like you say, it's a mindset change. You're like, okay, the reality is we don't have this cash available. Why is that? Are we profitable enough? Right? Do we need to look at our pricing? Do we need to look at our margins? Maybe we're not running efficiently, right? Maybe we need to collect quicker. Maybe we need to pay longer, right? Some people, they'll pay their trades and their vendors really quick, which is nice to make sure you don't forget. But if you're paying them quicker than you need to, that actually, is not good for your cash flow either, right? So that's something else to consider.
Yeah, you got to take a look at when you're receiving funds and when they're moving out of your business. I absolutely agree with that, and then just see what makes the most sense, because you're not there to bankroll someone else's project, right? It's your company's project, but I mean, you're also not there to bankroll your client's project. So you got to take a look at when they're paying you, and how long you have before you can pay your vendors reasonably.
Exactly. That's funny, Lyndon. That terminology is like thrown around often in this industry. It's like, I'm not your bank, right? Like, you hear that a lot when, especially when it comes to like the large GC subtrade type relationships, right? Sometimes it can get a little bit gross how sometimes that might be abused a little bit where payments are stretched out for a long time. But yeah, you hear that quite a bit, unfortunately.
Good. So Josh, just looking at like smaller companies that are kind of in the trades, maybe like a $2 to $5 million company. They do you anticipate that those types of businesses would have a controller or someone who could manage the administer these different bank accounts, move those funds around? Who's typically responsible? What does that look like? What does the administration look like when actually having these multiple bank accounts? Is it a lot to manage? I wonder if we can maybe just lean into that a little here.
Yeah, that's a really good question, and I'm going to put my accountant hat on and just say it depends, which is usually our first response to things. It really does depend, because let's take quick answer to your question. Usually, a company that's like 2 to 5 million top line revenue doesn't have a controller. Like, it's quite often the owner that's still kind of running the finances on that end. We do at BasePoint, we have like virtual controller CFO services that are like a fraction of the cost of having a full time, so you still get that functionality within there. But yeah, I mean, you typically won't see it at that size company. But getting to like the question about like the mechanics of how to manage something like that, that it depends on the nature of the business. Like, say you're say you have a millwork company and you just have like a few large projects on the go at any given time, right? Or say like mechanical electrical company or something, like, well, any of the trade scopes really. Like, if you're focused on bigger projects, you'll have lower volume. And so your money coming into the bank, it will be fewer deposits, but larger, right? So then managing something like that would be less cumbersome because it's not high volume. If you're like plumbing service, right? Like residential plumbing service, and you're doing like service calls constantly, you have high volume of transactions coming in. And so something like this could be a little bit more cumbersome. And so maybe, the management of that is less based on, okay, cash came in, let's move it out. And maybe it's a weekly allocation process instead, because there's always trade-offs to these things, right? It's like, okay, it's good to be able to manage your money in this kind of way, or your cash. But you also don't want to be spending all your time doing it, right? Like, you want it to work for you. And this is where, we've seen clients with like a ton of bank accounts doing profit first methodology. And it's like, okay, like if you're kind of not using it well, then maybe you need to shift it a little bit and trim it down. And so what I've seen, over the years, I think what works best is an operations account, a tax account, and then a profit account.
Yeah.
And then the tax account, usually that's kind of, you're moving money through there typically on a monthly basis, because in Canada you've got GST, HST returns, often monthly, if not like quarterly at the least. For
Okay.
smaller companies, annual, but usually there's installments. So money's moving out of there fairly quickly. So that could be like a savings account, right?
Yeah.
Set up an extra savings account. But then as far as the profit goes, if that's going to sit for a bit, you can take it out quarterly if you like. I think at Profit First, they recommend, quarterly allocations in the same way, say like a publicly traded company would issue dividends to shareholders, try to get into that cadence. But, if you set up like a GIC account or something like that, at least you're getting some decent return by the cash that's
Some
sitting there.
interest, earning some interest on it. Yeah.
Yeah.
And in terms of like a profit account, are there other options that you could consider? So how I have it is that your operations account would be your typical check account. You'd
Yeah.
obviously have your credit cards that your company credit cards that you'd settle
Yeah.
monthly, however frequently that happens. And then your tax account would be a savings account, something really basic. These things shouldn't cost your business money, and I think the biggest thing here is that you don't want to create unnecessary administration, but you do
Totally.
want to have a handle on your cash flow.
Yeah.
And then on the profit side of things, are there other options to consider? I mean, you mentioned GIC. I've seen companies invest in other other investments,
Mm-hmm.
short-term investments, and get really great returns in that.
Yeah, so this is where I would say this is not formal investment advice, so don't take it as such. But my thought is it would depend on the risk tolerance of the owner, because that pool, that cash that's sitting there for profit is yours, right? Like that's set aside for your profit. And so if your risk tolerance is high and you're okay potentially losing capital on it, like the actual principal, then investments might be something to consider. The reason I mentioned GIC is, typically when we're having these conversations with clients, it's like a GIC is going to get generally, there was a weird period over the last couple of years where this changed a little bit, but generally GIC is going to get you better interest than like most savings accounts, right? So if it's a savings account is sitting there for a year, then that's like wasted money, right? I mean, you're kind of losing money at that point with inflation. So, yeah, as far as GICs versus investments, that would be a risk tolerance question, because with the GIC, the capital is protected, right? You're not going to have valuation changes of the equities that you're holding, and so you're not going to lose money. Whereas if you put it into equities, like the equities market and investments, then there's that risk, right? That if all of a sudden whatever you're invested in tanks, it's like, well, there goes my profit, right? So,
And
yeah.
what would it look like? I mean, and this could be probably another conversation, but to leverage that profit account or the money that gets portioned to that profit account to build up an asset portfolio
Mhm.
for the owner or the company.
Yeah, that's a good question, Lyndon. And this starts diving into investment management, which might warrant like another podcast for sure. But there's things to consider as far as tax implications within a corporation, especially in Canada. There's some disincentives to having investments within a corp. Now, there's times where it makes sense, and there's ways to kind of work with that. But there are implications to consider there. And as far as how it also, in doing that, it may impact your small business deduction, which may impact your corporate tax rate. Also, if you're thinking about selling your business, especially in Canada, if you're thinking about utilizing the lifetime capital gains exemption, which is a great way to minimize taxes on the sale of a corporation that you hold. If you have a lot of passive assets in the company, like assets that aren't actually for the purpose of your operating business, it may actually disqualify you from being able to claim that. So there's things that need to be considered in all of that as far as building up an investment portfolio. You might be, this is getting into technical tax planning, so I'm hesitant to say what you might want to think about or not as far as like setting up holdcos or trusts or whatever. But there's ways to, yeah, I would say when you're thinking about building up an investment portfolio, that would maybe be separate from like even the profit allocation. I mean, for the purposes of our conversation here, you want to make
Mhm.
sure you're taking profit out of your operating account, so at least you'll be taking profit from the company, and not inadvertently spending it, on stuff that is necessary for the business. There's always justification for getting equipment or buying this new software or whatever it might be. But then it often comes, and this gets back to your term about like the firewall, right? It often comes at the expense of inadvertently taking cash that you had initially allocated for yourself as the owner.
All right, excellent. Yeah, I'm just thinking, just to kind of start wrapping up here. So we prefaced this conversation with building a cash flow firewall, and the idea of segmenting your bank accounts. So having an operations account, tax account, and a profit account. I mean, you could create more depending on if you've got the capacity and what your business structure looks like, what your jobs look like. Maybe you've got jobs that you just want to allocate in one account. But effectively, you just want to have those at minimum those three accounts. Doesn't matter what the nature of your business is. You have your operations, tax, and profit account. Now, just want to lean into that tax account one more time before we start wrapping up here. Um, what's a good way to provision, or like, yeah, like how do you provision for the tax that needs to go in there? So you're charging your clients GST, in some cases PST, HST, whatever taxes your province or country use. In South Africa, it's VAT, value added tax.
Yeah. I
Um,
think that's like the global term. Like if you use that term, most like finance people like, I know what that is. Whereas if you say GST, although GST is also used in other countries, that actual tax name. But sorry, keep going. I
So it's
digress.
pretty easy to identify, that amount that needs to be moved into your tax account. What about the provisional tax that you're drawing out of each project there? How do you do that? Like, what's the best practice? Do you have any recommendations on how much to take out as a percentage, or
Mhm.
is that a deeper question?
Yeah, that's a good question. And so, with percentages, using the profit first methodology, there's that whole idea of target allocation percentages, right? So, like the TAPS. So you have a percentage. So for $100 comes in the bank, you take a percentage for profit, percentage for tax, percentage for operations. And so, as far as planning or provisioning for tax obligations, I mean, say you're a construction company in BC, right? You're looking at 5%, and even Alberta. So most of our clients are kind of like Western Canada here. You're looking at like a 5% GST amount, right?
Mhm.
So $100 of revenue, you've got $5 of GST on top of that. So if you wanted to be super conservative and make sure you're never going to run into like a tax obligation cash constraint, then for every $100, like when you get your invoice payment of $105, put $5 into your tax account right off the bat. However, the reality is we also have expenses on which we also pay GST, right? And so, you know, maybe instead of 5%, you shift over 3% or something, because with the GST that you pay on your expenses will offset the amount of GST you have to remit to the CRA in that case. So that would cover the value add tax or GST, your sales tax rate, is to think of what that percentage might be offset by what you're paying on purchases. But then you also have your corporate tax, right? And so that's going to be based on your profitability. And so getting to your question about like, if you're looking at how much profit's coming out of the jobs, think of what your target profit margin would be. So if you're like, hey, we want to be like operating at like 20% gross margin, like in construction is pretty common target to try to aim for. Depending again on the scope, there's some scopes that are way better, some that are not so great relative to that. But if that's your target, you're like, okay, so 20%, say we have a project that's $1 million, so we got about $200,000 profit anticipated out of that. If the corporate tax rate in BC is 11%, right? Maybe you need to anticipate 11% coming off of that with the profit. And so it comes down to what your anticipated profit percentage is. and then what your anticipated tax percentage is, and then siphon that off into there. I would highly recommend for anyone wanting to do this, just have a chat with your accountant and just be like, hey, what should I plan for this? Because it would take them 10 minutes to just do a little quick spreadsheet, and then you'll know, oh, okay, this percentage, right?
Well, I think the one thing that really came to light for me while you were sharing there, or while you're chatting about that is, like a budget. You have a budget for every job that you're doing. I mean, you're going to put an estimate together. You're going to put your numbers together. You're going to submit your proposals. That's kind of your budget for the job,
Yeah.
and that's your targets. Now, when you receive those funds, you kind of have an idea of like how much money you're going to put into your profit account, right?
Yeah. Yeah.
And then based on that, you can put that corporate tax amount 9, 10, 11%, where depends what it is, wherever you are,
Mm-hmm.
into that tax account. Yeah. So that
And
makes
recognizing, just real quickly too, like recognizing that 11% or whatever the provincial corporate tax rate is. Quick caveat to that is once you hit $500,000 of taxable income, now your corporate tax rate jumps up because you've now gone past that small business
substantially.
section.
Yeah.
But with that percentage, what was I going to say to that again? I lost my train of thought on that. Sorry, Lyndon. If it comes back to me, I'll mention it. Yes, that's what I was going to say. Sorry, is you're paying installments throughout the year as well, right? So say you did $250,000 of like taxable income last fiscal year, you're going to be paying installments on that. So if you are anticipating $500,000 of taxable income this year, the only difference is going to be $250,000 now that you're not covering with installments. And so it might not be 11% of all your profit because you're already paying installments to the CRA over the course of the year. It's that differential. So that's why it's pertinent for growing and scaling companies to be aware of that.
Okay, excellent. Josh, we got to wrap up here, so just to make sure we're on time.
All right.
And any sort of key takeaways that you just want to leave our listeners with?
Yeah, I think these things can become overcomplicated and they can become cumbersome. And so try to find a system that works for you. I think that's why, we've both kind of talked about this. 3 accounts is good, right? You can try to go like the whole methodology as far as profit first goes. There's multiple accounts to set up there in addition. But if you set up like an operating account, which is just a regular checking, set up a savings, maybe an additional savings account to start, so you don't have to worry about the whole GIC setup or whatever. So you've got 3 accounts. That should keep it pretty straightforward, not very cumbersome. If you have high volume of transactions, don't try to make these allocations with every cash inflow, right? Maybe do it on a weekly basis. You want it to work well for you and not become an entirely new project in and of itself. But the whole goal is to get you thinking about your cash in a way that prioritizes making sure you're taking your profit because you're the business owner, right? You pay yourself a salary to do what it is that you do in the business. But as the business owner, you should also be rewarded for the profits because it's your risk and your time and your blood, sweat, and tears that you put into it. And so mechanisms like this really help making sure you can take out a profit.
Yeah, I think like what you said there, it's your risk. Everybody puts their blood, sweat, and tears in, or probably the owner more than anybody else. No one's ever going to work as hard as the owner does.
Yeah. Yeah.
But yeah, it's their risk, right? And that's really, what they're in it for is that right there.
Yeah. Well, otherwise it's a hobby, right?
Yeah. Awesome. I'm going to wrap us up over there. Thanks everybody for listening, and stay tuned. We've got a couple more episodes that are going to be speaking about profitability and cash flow. I think the next one we're going to dive into gross and net margin, and we're going to have a conversation around what that looks like. So stay tuned, and we'll look forward to sharing some more information with you and having conversations about building better businesses.
Awesome. Thanks, everyone.